Hi, this is Brad Levin, CEO of Legacy Wealth Partners. Thanks for joining me today. It's August 22nd, 2017. I'm going to spend a very brief few minutes talking about the financial markets performance, but more importantly, I want to talk about the recent volatility that we're starting to see creep into the markets. There's been a lot of comments lately from notable investors, economists, and also some politicians suggesting that we could be in store for a major correction on the order of 50% or more. So I want to talk about that a little bit and share with you our perspective. As I know you're well aware, stocks have been performing quite well in 2017. This chart indicates the performance of major market indices through July 31st. U.S. equities, measured by the S&P 500, were up almost 10%. Foreign stocks are performing slightly better, and emerging market equities have performed more than twice as well, returning almost 24% so far this year. But in recent weeks, we started to see that performance begin to wane as investors are starting to question the validity of the Trump agenda playing out as previously thought. Especially since the beginning of August, volatility has started to pick up noticeably as investors have become more nervous. We've seen the tension between North Korea and the U.S. flare up, especially because of the tough rhetoric that's been coming from both sides. And as the tensions were starting to subside a bit from North Korea, violence broke out in Charlottesville, Virginia, creating more anxiety in the market, also followed by the disappointing response from President Trump, which added more anxiety. Then just last week, there was another terrorist attack in Spain, followed by further dysfunction in Washington. And as the business leaders advising President Trump decided to disband the Manufacturers Advisory Council, we saw the rift between President Trump and business leaders widen further. There were also rumors that Gary Cohn, the chief economic advisor to President Trump, may resign from his position, which also added to the market volatility. And then Friday, the market digested the news that Steve Bannon, President Trump's chief strategist, was out at the White House. To get a better sense of the market's recent action, take a look at this chart of the S&P 500 index. I've highlighted the performance over the last couple of months by the green oval. You'll notice that the stock market has had difficulty actually continuing its uptrend and has experienced a lot of congestion, as we would refer to it, tending to move more horizontally than vertical since the beginning of May. The stock market has several times reached the level of 2,480 and is in fact peaked out at 2,490 but not closed above 2,480. It is experiencing what technicians would refer to as resistance or congestion around this level. That would suggest that the trend is now beginning to break down a bit, certainly starting to look a little bit tired. The market closed at 24.25 last Friday, representing just about a 2% pullback from its all-time closing high. So the trend is not beginning to weaken significantly yet, but it's certainly showing signs of strain. The performance of large company stocks has been actually quite strong relative to that of the small cap index, the Russell 2000, which is down about 5.5% from its all-time high. My take on this is that large companies generate a lot of their revenue from overseas sales, which is currently benefiting from a weakening trend in the US dollar. Small companies generate a lot less of their profits from foreign sales, so they're not reflecting as much of the benefit from the US dollar decline. So the data that we took a look at would certainly suggest that the market's trend is beginning to weaken. But is this a sign of the beginning of a major market correction or even a bear market? That's what we want to take a look at next. One of the ways that we can gauge the potential for rising volatility in the stock market is by taking a look at the VIX Index, which tracks the level of implied volatility in the options market. This is a fancy way of saying when investors feel more fearful, they will buy put options to protect against the value of the stock market declining. The VIX Index tracks that level of market volatility implied in the price of options. So when the VIX rises, it's suggesting that investors are feeling more fearful. Now, this chart shows that from 1993 through December of 2016, the VIX has been below the level of 10 just 16 times, and 8 of those times alone occurred in the year 2017. In other words, investors have been surprisingly calm all this year despite all the drama that's played out. This chart zooms in on the performance of the VIX index over the last several months, and we can see that it's been hovering around the level of 10 for most of this period of time, and in fact for most of 2017. But we notice a significant uptick in the level of the VIX just since the beginning of August, reflecting the potential for a lot more volatility as investors are becoming more fearful. With the VIX rising, it's natural to question the possibility of a market correction. But if we are in the midst of a correction, how significant might it be? Or could we be in store for a full-out bear market? Take a look at this information presented by JP Morgan, which puts the history of the market's volatility into perspective. Going back to 1980, we've had 37 years. And over the course of those years, the average intra-year decline is illustrated by the maroon dots. It's averaged 14.1% per year. Yet we've had 28 positive years out of these 37 years. So this suggests while we should expect some volatility annually, that doesn't negate the expectation of positive returns for the market in most years. Now, so far this year, we've not experienced even a 5% drop in the market. So if we have a correction, we shouldn't be surprised at all. Another reason to suggest that stocks are in store for a correction is if we consider the valuation levels of stocks, which are quite high right now. This chart shows the 12-month forward price-to-earnings ratio for stocks, which is currently sitting at 17.4. That's well above the 5-year average, as well as also above the 10-year average by a large margin. This would suggest to us that stocks should correct to bring those valuation levels back down. Another way of looking at the valuation levels of stocks is through the use of the Shiller cyclically adjusted price-to-earnings ratio, also known as the CAPE, developed by Professor and Nobel Prize winner Robert Shiller. According to this valuation metric, today stocks are sitting at the third priciest level in history. According to Robert Shiller himself, the U.S. stock market hasn't been this overvalued except for a couple of times in history, around 1929 and around 2000. But if you go back to 1998, you'll find that the CAPE ratio is about the same as it is now, and yet it kept going for 2 more years. It got up to something like 45 in the year 2000. We could go back up there. So stocks are expensive right now, but Professor Shiller is saying they could go even higher from here before they experience a significant pullback. As I indicated, we shouldn't be surprised to see a market correction during the course of any year. However, we need to be concerned about the potential for a bear market, which is defined as a decline of at least 20%. We've had only 10 bear markets since 1925, and they're illustrated here on this chart prepared by JP Morgan. We also see on this chart the environmental factors that existed during those bear markets. You can see those identified by the blue diamonds. Now, extreme valuations existed during 5 of those bear markets. But the greatest cause of bear markets were recessions. And we can see that extreme valuations occurred as the sole source of the bear market only 2 times in history. The first one occurred here as shown in 1962. And that bear market lasted only 7 months long before the recovery began. The second one occurred after the infamous stock market crash of 1987. And yet that bear market was also very short-lived, lasting just 3 months. So we can see here that extreme valuations have occurred only 5 times in history as the cause of bear markets, and only 2 of those periods resulted in bear markets as the sole cause. Recessions, on the other hand, are the main reason that bull markets end and result in bear markets. So we really have to consider the potential for recession as the big risk that would trigger the next bear market. Since a recession is really reflective of a slowdown in the U.S. economy, let's take a look at the fundamentals to see how the economy is holding up. First, GDP, or economic growth. In the second quarter, came in at a pretty strong 2.6%, especially in comparison to the weak first quarter of 1.2%. So that's something to smile about. The job market is still very strong, and the unemployment rate is now down to 4.3%. Consumer sentiment is also very strong. A preliminary reading for August just came out, reflecting 97.6%, actually the highest reading since January, which is quite surprising considering all the drama in Washington. Consumer sentiment is also strong currently. The preliminary reading for August just came out at 97.6%, the highest reading since January. Corporate earnings also are very strong right now. 73% of companies in the S&P 500 have reported second quarter earnings ahead of expectations, and they're reflecting a growth rate of 10.1%. We're at a record level of corporate earnings in history. Corporate earnings are also very strong, now hitting all-time highs. As of last Friday, 73% of the companies in the S&P 500 that have reported second quarter earnings came in ahead of expectations, reflecting a growth rate of 10.1%. Additionally, 69% of the companies making up the S&P 500 have reported second quarter revenue or sales ahead of expectations as well. That's well above the 5-year average. And despite the fact that the Federal Reserve has now raised interest rates 4 times, interest rates are still historically very low. Inflation is also still quite benign. In fact, it's well below the Federal Reserve's target of 2%, which suggests at this point the Federal Reserve is not seeing enough inflationary pressure to justify aggressive tightening of interest rates. They'll likely raise rates just one more time in 2017. So when we take a look at the fundamentals of the U.S. economy in summation, we can easily see that the recessionary risk is quite low at this point because the economy is quite strong. Yet despite strong fundamentals, one thing that most investors are concerned about is geopolitical risk. And yet investors remain calm despite a wealth of geopolitical shocks. We were calm when the United States launched a military strike on Syria, and when we dropped our biggest non-nuclear bomb in history on Afghanistan. And yet we remain calm throughout terrorist attacks that have taken place in Sweden, Russia, France, the United Kingdom, and most recently Spain. We didn't even flinch as the European Union unraveled or when the U.S. government flailed. Maybe 2017 will go down in history as the Teflon year. Yet we are mindful that the risk of geopolitical shock and its impact on the stock market is ever present. I've now explored a lot of individual facets for you, but let's put it all together and look at the Legacy Wealth Partners macroeconomic dashboard. We can see the majority of our dials are flashing a green positive dynamic. U.S. economic growth has ticked up compared to the last quarter, and all the other dials are flashing green, except for high equity valuations and geopolitical risk, which remain our two biggest concerns right now. Collectively, in the current environment, we feel cautiously optimistic. In fact, our current outlook is not that dissimilar from what was recently reflected by Charles Schwab in their June market perspective. Goldilocks appears to have arrived. Low interest rates, improving earnings, a strong labor market, calm inflation, and a still accommodative monetary policy. But as always, there are clouds on the horizon and pullbacks are possible at any time. So it's important for investors to remain vigilant in keeping a diversified portfolio with appropriate risk exposure. In keeping with the Goldilocks theme, we will point out three potential pitfalls or bears worth watching: an economic slowdown, a domestic political implosion, or geopolitical blowup. None appear to be imminent, but the latter of the two could appear suddenly. But if a correction does in fact play out, what are we at Legacy Wealth Partners going to do on behalf of our clients? What I'll tell you is that we're going to do what we always have, and that is to invest based on a belief that quality long-term results can be achieved and improved by following a consistent and repeatable method driven by robust quantitative data. After determining the appropriate level of risk for each client, we allocate portfolios based on the use of fundamental inputs, data about the U.S. and the global economy to tell us how the market should be behaving, as well as technical research that helps us understand the behavior of markets by following their current trends. These components together become what we call the weight of the evidence, and it is this evidence rather than hunches or emotional tendencies that guide our investment decisions. Thank you once again for taking the time to join me today. I hope this information has been helpful for you. And if you have any individual questions you'd like to address, please don't hesitate to reach out to us.